Good evening, guys. This is again your Prof. Zeus, and welcome to another session, this time of partnership and corporation. Okay, so this is our first time to discuss about partnership, and this is for you guys, my students in Aureliano University, first year. Okay, so what is a partnership? That's the first thing that we have to define. Okay, so what is a partnership? A partnership actually is formed. So let's have this. Okay. So a partnership is formed when two or more individuals. Remember ha, two or more, hindi pwedeng mag-isa ka lang. Sabi yung form ka ng partnership, mag-isa mo. Walang ganon, okay? So when two or more individuals agreed to contribute money, property, or their industry. Okay? Paano ba yung yung parang muscle yan? Okay? Yan, kunwari muscle yan, yan. So, they agreed to contribute money, property, and industry to a common fund. So, this is the common fund of the company with the intention of dividing the profits among themselves. So, this is the profit distribution. Okay? Okay, so what the partners will do is to operate the business, use the assets, the money, the property, and the industry contributed by the partners in order to generate revenues, incur expenses, and of course, the resulting profit or loss from the partnership, which will be subjected to distribution. Okay? Now, a partnership is formed by two or more individuals, and then we have, of course, what we call the articles of partnership. So this is a document, articles of partnership. So this is a document that is filed with the Securities and Exchange Commission, and once the Securities and Exchange Commission releases a certificate of registration, okay, to the partners, then there's already a juridical registration. There's already a juridical entity that is created, and that is, of course, the partnership. The partnership as a separate entity can own properties, okay, it can transact to individuals and even others, no, in order to operate the partnership. Okay, so there are different types of partners. Okay, number one, we have what we call the capitalist partners. Capitalist partners. So as the term implies, when you speak of capitalist partners, they are the ones who contribute money. Okay, they're the ones to contribute money to the partnership that is used by the partners to operate and generate revenue for the firm. Number two, we have the industrial partner. So an industrial partner or industrial partners, okay, they actually contribute their effort, the services. Okay, so money and this one is services. Okay, so they contribute their services to the firm. Okay, like labor. Okay, and of course, because they're contributing labor, they're not subject to, they do not share in the losses, only in the profit of the firm. Okay, so that's one of the many types of partners. And of course, we have the capitalist and industrial partner. It's a combination of the two. Okay, now as to that, so this is with regard to the contributions. Now, another set of or types of partners is with regard to the liabilities, assumption of liabilities to third parties. Okay, so liabilities, number one, we have what we call the general partner. Now, si general partner, anong ibig sabihin niyan? Siya ngayon ang mayroong full accountability dun sa liabilities ng firm. So the liability could extend even to the personal assets of the general partner. So kung wala na siyang pambayad, for example, ng utang ng partnership, then the creditors can run after his personal assets, no, sell the assets, and then apply the proceeds to whatever liabilities the partnership has to other parties, and then whatever is left will be given back to him. Okay, and of course we have what we call the limited partner. Now, limited partners, okay, in insofar as liability is concerned, now their liability to third parties is limited to their capital contribution. Okay? Capital contribution naman yung limitation. So dito, up to personal assets. Whereas, kapag limited partner, up to capital contribution. So if he contributed, say, 100,000, then the liability that it can absorb would only be up to 100,000. Other than that, wala na. No, the creditors cannot run after the personal assets of the partner. Okay, so there's still a lot of different types of partners according to management. All the stuff I'm leaving it to you guys to understand and of course read those theory parts. Now, with regard to the articles of partnership, what are the things that's in the articles of partnership? Okay, number one, of course, the name of the partnership. So, for example, in the case of the accounting firm that I have, it is named after the partners. That's Aboy, Empleo, Hiron, and Company. So that is the name that would appear or that appears in the articles of partnership. Okay, of course, the address of the firm. Okay, and then number three, of course, the names of the partners. And of course, the residences of the partners. Okay, and their capital contribution as well. What else? Of course, who is the general partner? Name of the general partner. And then, of course, the profit and loss sharing. Now, these are some of the information contained in the articles of co-partnership. Articles of co-partnership. That is filed now with the Securities and Exchange Commission. So we have the name of the partnership, the address of the firm, of course the what's this? The objectives, okay? The objectives or the objective of the firm. The reason why the firm was created, okay? That is of course to service or to act as accountants for businesses and all the stuff. So what is the reason why you are creating that partnership? That should be part of the articles of co-partnership. Okay. Now, insofar as accounting for partnership is concerned, it is essentially the same as accounting for sole proprietorship. Yun nga lang dito kasi we have two or more partners. Now, in a sole proprietorship, remember that you only have one capital account, one capital, and one drawing account, right? In a partnership setup, each partner will have its own capital account. So, if you have two partners, then they will have two capital accounts. So each partner will have its own. Each partner will have its own capital account. So we will maintain a separate capital account for each of the partner, not only capital but also drawing account. Because the drawing account will be we're able to monitor the withdrawals, of course, and the withdrawals of the partners. No, I mean amount that we withdrew from the partnership, the additional contributions that that will infuse during the year, and even the share in the profit or loss of the partnership. Okay, so doon nakalagay yan sa partnership sa drawing account ng mga partners. Okay, now how can a partnership be formed? Okay, una-una, pwedeng dalawang tao, no? Nagsimula sila, nag-usap sila, then they agreed to form a partnership. And sabi nga natin, they can contribute money, assuming both of them contributed 100,000 each. to establish a firm. So how are we going to record this? So in the partnership book, we will just record this as simply debit cash, 100,000, assuming that this is A and this is B. So A capital, this is 200,000, so 100,000. Then B capital, that's 100,000. Okay, so this is in terms of money. Okay, now another is the two of them agreed to form a partnership. One is contributing money for 100,000, and the other one is contributing, say for example, a non-cash asset, say a delivery truck. Okay, so in this case, there's a what? Contribution of money and non-cash asset. When it comes to non-cash asset, remember that we are going to record this using the fair market value of the assets at the time of contribution. When you speak of fair market value, this is actually the price that is agreed by the partner, agreed by the partners. So assuming that they were able to say check, how much is the price of the delivery truck, that they can assign that price as agreed by the partner, and that will be the fair market value of the asset. Okay, so let us assume that the fair market value of the delivery truck is 200,000. So how are we going to record this? So debit cash, 100,000, debit delivery truck, 200,000, debit A capital, 100,000, and B capital, 200,000. Okay, so this is now our entry to record the contributions of the partner. Now, what if instead of contributing cash or non-cash asset, the partner will contribute his industry, meaning his labor to the firm? Okay, remember, when it comes to contribution by industry, the company or the firm did not receive any tangible asset. Okay, no cash, no non-cash asset was received by the firm from the partner. So therefore, in that case, we are not going to record the contribution using this usual journal entry. We will use the memorandum entry, okay, to record the admission of another partner that contributes industry. So therefore, C was admitted into the partnership as an industrial partner. Okay, and shares, say 30% of profit. Now it is to be noted, you have to note that when industrial partners are admitted into the partnership, they do not share in the losses of the firm. They share only in the income, because according to the law, the mere labor that they contributed is already enough loss for them. So they should not be sharing on the losses of the firm. Okay, so this is one way of forming a partnership. Okay, by contribution, say none of them is in business, they would like to form a partnership so they can contribute cash or money, in which case we just record the money by the amount that we receive from the partners, debit cash, credit the capital accounts. Okay, now if it is a non-cash asset, then we have to determine the fair market value of the non-cash asset. Okay, and accordingly, we record the contribution using the fair market value of the non-cash asset. And if it's by industry, then we record the contribution by the partner, by the industrial partner, using a memorandum entry. Okay, and remember, he is not going to contribute or to share in the losses of the firm. He will only contribute to the he will only share in the profits of the company. Okay. Now, another way of forming a partnership is, say for example, this is A. He doesn't have any business, and he invited B. B now has a business, has an existing business. Now, A invited B, okay, to join him in the business. Now, however, B has an existing business. Let us assume that B's business has the following details. So assuming that the trial balance, okay, let's have the trial balance of P. Okay, so this is say B shop. Okay, yan. So assuming the trial balance contains the following assets and liabilities, okay? Okay, so let us try to find out how much is the value. So that's 100,000 plus 250 plus 10 plus 500,000. So this is 860,000. Assuming that this is also 860, so how much is the capital? So less 50 less 20. So the capital is 790. Okay. So assuming that this is the trial balance of B's business, okay, he has a business and then he's invited by A, and A will contribute the same amount of the adjusted capital of B. Now let us assume that, as I said earlier, when non-cash assets are contributed, then the partners have to agree on the valuation of the non-cash asset. Okay, so let us assume that based on the agreement between A and B, number one, that the accounts receivable, okay, is we shall set up 10% as allowance for doubtful accounts. Okay, and then number two, that the supplies is half used. Okay, and then number three, that the truck, okay, should be depreciated over, say, 4 years. Okay, assuming these are the agreements when it comes to the values of the items that B will contribute to the partnership. Okay, there's no adjustment for cash because we record cash by the amount of the cash that we received. Now in AR for example, so AR, how much is the AR balance? 250,000. And according to the agreement, there should be a 10% allowance. So this is equal to 25. What is in the books is 20. So we need to increase allowance by 5. Okay? So we need to increase the allowance by 5. Okay? And then for the supplies is 10,000, but it is already half used, so less 5,000. So therefore, we have to adjust another 5,000 for expense. Right? And then for the truck, how about the truck? So that's 500,000 divided by 4. So that's 500,000 divided by 4. So that's 125. So this is now the accumulated 125. Right? Now what is in the books is how much? 50. So less 50,000. So therefore, we should increase the accumulated depreciation by 75,000. Okay, so this will be the adjustments in order for the partnership to push through. First and foremost, we have to adjust AR. We have to increase. So increase allowance for doubtful accounts by 5,000. And then number two, decrease supplies by half, by 5,000 as well. And then number three, increase the accumulated depreciation by 75,000. Okay, so after effecting this one to the capital account of the part of letter B, then we will have the fair value of the assets. Okay, so what are the adjustments that we need to record in the books of B. Okay, so what are the adjustments? We will increase the allowance for doubtful accounts. So if we increase expense, actually the usual entry here is you have the doubtful accounts expense and then allowance for doubtful accounts, right? So 5,000. However, the expense is what? An offset against the capital. So might as well use the capital account. Okay, so number one, debit your B capital for 5,000 pesos and credit allowance for doubtful accounts for 5,000 pesos. Okay, so we're done with this one. Decrease supplies by 5,000. Okay, so therefore again, it should be what? Expense, supplies expense, and credit supplies on hand. For how much? 5,000 pesos. But then, since this is expense, it's already, we can offset that against the capital directly. So debit capital 5,000 and credit your supplies for 5,000 pesos. Okay, now the third one. Okay, so here the entry is what? Depreciation expense and then accumulated depreciation for 75,000. So therefore debit B capital for 75,000 and credit accumulated depreciation for 75,000. Okay, so if we now try to find the capital, the adjusted capital of B, how much do we have? So there's a 790,000 capital based on the trial balance of B provided by B. Now we debited B capital for 5,000 pesos. We debited B capital for another 5,000 pesos. And we debited another B capital for 75,000. So therefore, how much is the adjusted capital of B? So that's 5,000 plus 5,000 plus 75,000. So this is 85,000. Again, 790,000. So therefore, the adjusted capital of B is how much? Sorry. 790,000 minus 85,000. That is 705,000. So this is now the adjusted capital of B. And therefore, A will also contribute 705,000 into the partnership. Okay, so what will happen is that we will now close the books of B, assuming that the partnership will use another set of books of accounts. So we will close the books of B and then open the books of the company. Okay, so let's close the books of B. So therefore, okay, closing entries for the books of B. Books of B. So we will close. When we close, what do we mean by closing? We put all the accounts to zero. So we have this, okay, except for the, of course, adjustments in here, no? Okay, let us close. So we will close B capital. For how much was that? 705,000. Credit cash for how much? 100,000. Credit accounts receivable for how much? 250,000. Credit truck for 500,000. Then credit debit, you have your accumulated depreciation. Accumulated depreciation is how much? That's 125,000. And credit your doubtful accounts expense. Allowance for doubtful accounts. So the allowance for doubtful accounts is how much? That is 25,000. Okay, now let us see if debit is equal to credit. So 125,000 plus 705 plus 25. So that is 855. So 855. So the total debit is 855,000. Let us see the total credit. So 100 plus 250 plus 500 So this is 850. Ano nangyari? Nangyari doon. 250 accounts receivable. Let's see. 5 plus 5 plus 75 is 85 minus 790. That's 705. Okay. What went wrong? The allowance for doubtful accounts is 25. This is correct. The accumulated depreciation is 125. This is correct. And then cash is 100. Accounts receivable is 250. And this is 500. So what went wrong? Oh, the supplies. We haven't reported the supplies. Supplies, tama. So supplies, credit supplies for 5,000. There you go. Okay, so we have already closed the books of B. So what we will do now is to open the books of the partnership. So assuming, let us say it's A and B partnership. So in the books of A and B partnership, how are we going to record the contribution? Now, as we said, A will contribute the same amount of B. So adjusted B capital is 705. So therefore, we will record cash, 705,000, and credit A capital for 705. Alright? So this is to record capital of A. Capital of A. And then to record the contribution of B, we will now record the accounts that he has contributed. So debit cash, 100,000. Debit accounts receivable for 250,000. Debit truck. Now for the truck, we will record this at fair value, meaning we will take out the 125. So that's 500,000. That's 125,000. So this is 375. And then we have the supplies for 5,000 pesos. Okay? And then we have the allowance for doubtful accounts. So this is the difference, no? The things allowance for doubtful accounts, we will still recognize the doubtful accounts, okay, the allowance for doubtful accounts in the books of the partnership. The reason being is that it is still possible that we will be able to collect the amount we have initially considered as doubtful of collection. Okay, so the allowance for doubtful accounts is 25,000, and then of course B capital. How much is this? So that is 705, right? 705,000. Okay, so let us see again. So 100 plus 250,000 plus 375 plus 5,000, 730. So this is 730,000. Total debit and total credit is also 730. Okay, so we now have the opening entries in the books of the partnership. Now let us do the balance sheet. Okay, so we have A and B partnership. So statement of financial position. Say as of January 1, 2019. Okay, so among the assets, you have current assets of, so you have cash. How much is cash? So that's 100 plus 705 plus 705, that's 805,000. Then you have accounts receivable for how much? That's 250,000 less allowance of 25,000. So that's 250 less 25,000. That's 225,000. And then you have the supplies of 5,000 pesos. So therefore, the total current assets is plus 805. 1,035. This is the total current assets. Then you have the truck. So non-current assets. Sorry. So you have the truck for 375. So how much is that? Plus 375. So that is 1,410,000. And then here you have no liability, so you have just the partner's capital. So you have A capital for, how much is A capital? 705,000. And then B capital is also 705. So therefore, the total capital is 1,410, which is total to your assets. Okay, so this is total assets and this is total capital. So there you have it. This is actually chapter 1. Okay, so we're done with chapter 1. Now what I'd like you to do as an assignment, see, that's very easy, right? What I'd like you to do is do this at home. Let's have the practice exercises. Okay, let's have this one. Okay, kindly do the problems. So problems 1, 2, 3, 4, 5. Okay, kindly do all the problems for partnership. That's chapter 1. Okay, again, we're using the book of Fundamentals of Accounting, Volume 2, Partnership and Corporation, 2021 edition by Dr. Patricia M. Empleo, Nonita Robles, and Christopher Herman. Okay, thank you very much to the authors. We have a very good book for partnership and corporation. Okay, now this has been your Professor Zeus, and I hope you learned something from our discussion on chapter 1 about fundamentals of accounting, covering partnership formation. Okay, if you have questions, please just raise your questions in the comments box, and then I will answer them as I go on when I go online. Okay, thank you very much, and please stay safe, and see you again in my next video. Don't forget to subscribe and invite your friends. Who knows, you might be able to help them in terms of access to information. Thank you very much, and see you again. Bye.